Welcome back, and we will have a fundamental conversation very, very shortly. But before that, Kunal, your picks for this afternoon. You've got maybe an hour and 10 minutes of trade left. Uh, what are your trades for the next hour?
So I'll suggest a buy on delivery. That's a
Okay.
chart which is looking attractive. In fact, we've been discussing this that stocks which are ending the corrective phases, they tend to become very very attractive at lower levels. Delivery seems to have completed that kind of a corrective wave. It's bouncing off slight above its 200 moving average. So risk reward extremely attractive. Would look out for a buy with a target of 430. Stop us at 410. And in the similar vein, PSU banking stocks now I believe have come back towards a very attractive point. So would look out for Bank of Baroda. Would suggest a buy with a near-term target of 295. Stop loss could be kept at 285.
Kunal, if I can toss in a question on Asian Paints, what's happening there? 4.5% Nifty 50 counter, which has shown remarkable strength over the last maybe month and a half. What's happening here?
See, I think to sum it up, the selling is rotational for stocks. So, for example, today you also have names like ICICI Bank, which was one of the stronger ones, is into a negative price terrain. So this is a phase of the markets where even the strongest of the stocks at some point of time would go into that selling spree or into that selling juncture. It could also be one of the reasons why I would believe that mark-to-market selling generally happens, because when you have your portfolio which is maybe bleeding as such, then you want to offset with gains which you've established in many of the other stocks. And Asian Paints was a classical stock in that sense. But this should not ideally deter longer-term investors or medium-term investors into buying the stock back again. These are part and parcels of every trend which happens into stock prices. They go into a phase of an extensive price rally, then a sudden price correction for the stocks, which maybe last for a magnitude of 5% to 10% broadly from their swing highs, but then they become attractive yet again. So I believe Asian Paints, say potentially over the next couple of days, I think should come back towards an attractive price point where traders could look at a contra buy.
Okay. All right. Let's go across. We have Srivatsa, beg your pardon, Executive Vice President and Fund Manager Equity at UTI AMC, joining us. Welcome, Mr. Srivatsa. Talk to us first off about what you make of Indigo, and I'm not taking a stock view from you. You've obviously seen enough cycles to understand as to what happens to companies with 60-70% market share, and what the risks could well be of owning a company like that in your portfolio. In your sense, is this kind of market share for an Indigo maintainable given the current environment, given the kind of pushback that the government is giving, or do you believe that the government is going to double down on something like an Indigo and maybe you could see market share dilution here? Just give us that sense, if you could.
Yeah, I can't specifically talk on a company, but broadly on the sector, what has happened is that because of the fact that in the last 10 years, so many airlines have collapsed and there is only one efficient player. So it has led to this situation of, a single player having 65% market share, and obviously any issues at their end, throws the entire system into disarray. Now, obviously, the government would want to cut it down, would want to bring down the share of the largest player in the industry to a more reasonable level of, say, 50-55%. But the equal challenging part is that the other three players are also not in great financial shape, in spite of very good operating environment in the last 1 year, in terms of, limited competition, buying crude. In spite of these factors, they are sitting on huge losses, and probably two of the players may not have even the capital to fund those losses, whereas the second player does have some amount of capital. So there would be a temporary setback in terms of some kind of a reset for the industry. But I don't see the industry dynamics changing very rapidly from, say, a player having 60% market share to going to 40, what it was 10-15 years back. I think that is still quite some time far away. And in spite of the fact that last 3 years we have just seen four players or virtually a two-player market, nobody has come and entered into the industry, which shows that given the kind of bloodbath which has happened over 2 decades, probably, nobody wants to, enter this industry. So there would be a temporary reset, temporary disruptions, but I will not call for a very structural change in the industry per se, over the next, in the medium to long term.
I understand. Okay. Thank you, Mr. Srivatsa, for that view. I know it's a difficult question to answer without getting stock specific here, but thank you for that. It gives you a good insight or lens into how you're thinking. Uh, Talk to us about how you're viewing markets and how you're looking at the earnings cycle play out, right? We're likely to see earnings pick up starting H2. What's your view, and can we expect maybe the next year, FY27 as well as FY28, to be solid years of earnings growth? Is that something one can comfortably pencil in your opinion?
Yeah, I think if one looks at the earnings, definitely in the last 1 year, we have seen a fair amount of downgrades. Now, what has happened in the last, I would say, 9 to 10 months is very strong government action in both GST reforms as well as income tax reforms and effort in improving the liquidity on the system. All three factors have, led to I would say, a revival on the consumption side. So we are definitely seeing the impact of that, be it autos or durables. There has been a sharp pickup. And more importantly, banking, which is the largest sector in terms of weight as well as probably by profits, is also seeing a sharp kind of a turnaround, in terms of improvement in names, benign credit cost. So if I look at the next second half, definitely things looks better. If one extrapolates into next year, of course, there's a lot of variables which is still outside our control. Like, for example, crude. For some reason, crude goes back to 1995. It could really throw the entire equation out of gear. But as of now, the thing stands today. I would see a reasonable case of maybe a low double digit kind of a earnings growth for next year, which bodes very well for the market. See, what I believe is in the long, I think the performance in the market clearly depends on the earnings growth you can deliver. I mean, if one looks at, say, 20 to 24, very sharp earnings growth of 19-20%, equally sharp performance. So I think broadly the stars are aligned. But yes, the biggest risk that I see today is the trade. The US trade deal. If nothing comes in the next 3-4 months, there would definitely be a pressure on the market for sure. I think that is a risk that we need to watch out for. Bearing that, I think we should be comfortable in terms of earnings growth, and hopefully the market should follow that earnings growth.
What are the pockets, Shivatsa, that are looking attractive, either from a re-rating perspective or from a large pool of profit which may be which might become available to them in the next 5 years? Uh, are any of those looking good from a risk reward standpoint? Either, so you can catch multi-baggers either one of these ways, right? Give me a third if you have a third, or give me a sense of the sectors that fall into these two buckets.
See, I largely look at where valuations are, because
Sure.
I'm a very value focused fund manager. So clearly, I think to me, IT looks to be the best place. I think the market has penalized it for a very low kind of a growth visibility for this year. Plus, obviously, the impact of AI, which is still, not very clear whether AI will benefit or harm them. But as we see, I think clearly the demand visibility is improving every quarter, and we see no reason why it cannot improve next year. As I said, I think the verdict is still unclear whether AI will impact or benefit, but our view is that near term it may benefit for sure. And lastly, you also now have a very positive currency outlook in terms of, so there is a case of probably an earnings, at least the earnings being maintained for next year, which itself is a very good outcome, because valuation, at least if I look at the IT large cap, is pretty reasonable at around 20 times below the market and 4 to 5% free cash flow yields, which is the best you can get in their history. So I think over a period of time, over the last 10 years, if you see wherever the sector is traded in these valuations, maybe the outlook is bad, but they have always bounced back and outperformed. So that's one of my top sector picks. The second is, I think, oil and gas. Clearly, I see a case of a lower oil prices, which bodes very well for the sector, because a large profit pool comes from the OMC side. And secondly, I think also in the gas, after many years, we are likely to see a lower LNG prices, which should accelerate the demand pickup on the gas side, which should also bode well for the gas related stocks. So I think these are the two sectors that I would call out for from a broader perspective. Then you would also have an healthcare, which again has suffered on account of US issues and maybe not a very great domestic growth. But I see that also turning around. So these three are the large sector weights that I would pick. I mean, it's an overweight in across my funds.
Okay, Srivatsa, hang on there. Hang on to that thought. What we're going to do is slip into a very short break. We'll come back, continue this chat. It's very interesting, and we'll continue with regard to what you're liking within consumption. So, viewers, stay with us.
Back with closing trades right here on ET now. Still struggling for Asian Paints. That's down 4.5% as we speak right now. IndiGo's Aviation, of course, the most volatile chart today. That as well is still lower by about nearly 2% or so. IT under pressure today. TCS, you've got an HCL Technologies, Wipro, TechM, all down. And that's the case with the Reliance as well. Along with a couple of private banks, they as well are lowered. Having said that, on the flip side, Titan, Eternal, Shriram Finance, Adani Enterprises, BEL, Axis Bank, they are the ones which are actually pulling up a large part of the weight. And look at the recovery in Keynes for that matter, 12% higher as we speak. PG Electroplast, RVNL, Delivery, and the beaten down realty pocket from yesterday, that also seems to be making a comeback. Look at a Godrej Properties, for instance. It's almost notching a 4% gain as we speak right now. But we're still in conversation with the vsrivatsa. Srivatsa, wanted to figure out whether the pain in Keynes is quite done. I'm not sure if you're tracking the individual story or not, but the fact that the stock has finally bounced 12%.
Yeah, again, I can't give individual comments on stocks, but broadly, if I can talk on the sector, I think the whole EMS sector, I mean, they've got good visibility for growth, but I think the big challenge is whether they'll be able to generate enough operating cash flows. I think that's been an issue in some of the companies. And more important, I think if one looks at the growth areas, they are into very different areas where their credibility is not proven. So, and obviously the valuations are extremely on the higher side, giving them the full benefit of doubt on the execution. That's something that's not part of my portfolio, but it would be a wait and watch before I could, take a view on these the stocks in this particular sector. But I can't give a specific comment on a company.
But great to have you on the show today. Thank you so much for your time.
Thank you.
Right. Okay, let's take a very quick break on that note. When we come back, of course, the big interview that everyone has been waiting out for, the Civil Aviation Minister talking about the Indian skies and, of course, the state of IndiGo's Aviation. That on the other side of this break.